This is actually the method I personally use the most when it comes to trading breaker blocks. With this approach, we're going to use three different time frames. First, we use the daily time frame to establish our bias. Next, we use an intermediate time frame, which can be either the 4-hour or the 1-hour chart. And finally, we use a lower time frame for our entry, where we'll be looking for our breaker block. Now, on the daily chart, what are we mainly looking for? We're simply looking for directional bias. Just like we can see here, price swept the previous candle's high, which tells us that the most likely next draw on liquidity is this swing low. Now, instead of immediately dropping down to the lower time frame to look for an entry, the next step is to go to the intermediate time frame. On this time frame, we want to wait for order flow to align with our daily bias. And that's exactly what we can see here. Initially, price was pushing to the upside, but then we started seeing bearish order flow. Price respected this first fair value gap, and now it is reacting from the second fair value gap. This reaction is happening right at a lower high, which tells us that we should now be expecting a lower low. Once we've confirmed this on the intermediate time frame, the next step is simple. When price returns into our point of interest, we then drop down to the lower time frame. On the lower time frame, we wait for price to create a breaker block inside that intermediate time frame point of interest. Once that breaker block forms, we can now take our trade. From there, we either target the higher time frame draw on liquidity, or we simply aim for a 1-to-2 risk-to-reward ratio.